Okay, we're gonna get started. And I'm Hans Morris. I'm the moderator here. It's a quite amazing panel we have. And my background, I work in venture capital and managing partner at NYCA Partners. Interestingly, for this panel, I was also president of Visa during the IPO restructuring of Visa, so I would say I'm very familiar with payment ecosystems. So before we get started, I wanted to give you a little bit of context here. And hopefully we're gonna get beyond the headlines. So to me, one of the most important developments last year was that crypto as an asset class, as a speculation asset class, I would say declined in importance. Whereas the ecosystem, really crypto digital asset infrastructure, became much, much more important and much more real. And people can debate that. So how did that happen? So one thing was definitely stablecoins created stable money, stable digital money, and that's only in 4 years, really. And it was dependable, and then stablecoins started moving from basically a settlement layer for capital markets and DeFi transactions into an infrastructure layer with thousands and thousands of engineers and really smart people and lots of capital focusing on making these things work. That was really different. The other thing was we had the Genius Act passed, which everyone got a lot of attention, but there's about 50 jurisdictions now that have, in many cases, very well thought through regulatory frameworks for digital assets. And when you have that I think has enabled very rapid rise in infrastructure and can actually say, is this going to be a new set of payment rails, which are global, instant, very dependable, programmable, and highly efficient? So that's a big, big, big deal. And what is that going to take? But if we look at the data right now, when you say, okay, what's the volume? The number gets thrown around. It's like $60 trillion. I don't know who wants what you use, but that's on the internet. They say it's 60 trillion. Almost all of that, though, is still like over 90%, I would say, is in the settlement layer for the crypto ecosystem. What's moving outside of it? There's a couple of material ones. One is remittances. So that's 150 billion annual volume, but about 1% is now on stablecoins, so still very small. Payroll is 50 billion, but it's like less than 0.2%. And POS is really, really, really small, the direct crypto settlement. So I want to talk about some big numbers here. So when I was at Visa, we used to say the B2B payment opportunity was like 600 or 700 billion. The current number is 1.2 quadrillion. So quadrillion is 1,000 trillions. That is a really big number. So when we start talking about quadrillions, we should get focused on that. Here's the numbers. B2B payouts are 25 billion. B to government and government to business is also about trillion. Both are about 25 trillion. Buyer, supplier, supply chain, all that globally is about 150 trillion. Treasury, intercompany treasury movement, just businesses moving money around inside and between each other and hedging, it's about 500 trillion. And then capital markets transactions are also 500 trillion, which is why we're going to talk about that. And that includes financing, repo, how all this money moves inside 500 trillion per year. A lot of that is daily settlement. So when you're talking about quadrillions, we definitely, as I said, want to get focused on this. And my friend Aaron McCune, who is, I think, the smartest person out there in B2B topics, created 5 rules, 5 criteria that need to be met. And I think it's worth going through these for a second. One is you need data standardization and programmability. So programmability, what everyone's talked about, data standardization, like in an invoice, is that all standardized data? People have been trying to get that to work for decades. I mean, probably for as long as history has existed. It still is not complete. It requires manual reconciliation. We need that for this to really work. Second, we need interoperability. People have actually talked about that quite a bit in stablecoin applications. How do you get it between all these different types of digital assets to work? The third is money quality. And I'm going to leave you with one other fact. In addition to the 1.2 trillion, I want you to just remember one thing. All this B2B world, corporate treasury is a zero risk world. Zero operational risk, zero credit risk. Everything settles in a very predictable way. So the quality of that money and then the quality of the settlement is really important. So dependent settlement infrastructure is 4, and then safety, oversight, and governance is 5. I would say on those 5 criteria, we have a long way to go, actually. But it's promising. I think the progress that was made in the past year is really quite revolutionary. So enough talking about me, or enough talking about myself, but enough about me talking. Let me talk about the one more thing, and then I'll introduce our panel. I think everyone on the panel said, we really don't care about if it's stablecoins or tokenized deposits or deposit tokens or even utility tokens or digital money market funds. We're really just talking about the whole group of digital assets. All of those should be in the same ecosystem, and everyone said they're pretty much agnostic to how that works. So let me introduce our panel. So Aklil, who is head of corporate development at Coinbase, where you are, if you want to acquire stablecoins, you basically go to Coinbase. And Farooq, Malik is co-founder of Rain. Rain is, you have stablecoins, you want to spend them. And he has created what is, I think, truly revolutionary idea, which is a digital, you're pretty much the first ever digital Visa card, right? Yeah. From my experience, it is. And so you can settle when you buy something, regular little Visa card, but you can settle in stablecoins, or you can settle in several actual different currencies. Yoshi Yokokawa is founder and CEO of Alpaca. That's how do you acquire, trade, tokenize real-world assets. Runs a global brokerage firm, 45 countries, tens of millions of accounts. And then Bentzi Rabi is a CEO of Utila, where you store your stablecoins. You're a business, you need to have wallets that you support, maybe thousands of different applications, thousands of separate wallets, and manage all the regulatory requirements of that. So let's start. I'd like to ask each panelist, and maybe we'll go this way. So Bentzi, just talk about the stablecoin stack and what part you play in that exactly, and then we'll ask everyone to just put a little clarity around that.
Yeah, sure. So thanks for the introduction. So from my perspective, when I think about stablecoins, so let's imagine there are fintechs who are entering the space. Usually they need a few things. One thing, they need wallets, okay? So they need a place where these stablecoins can let in, can move from, with the ability, of course, to initiate transactions and, pay gas and do everything around. Second thing they need is everything related to liquidity, okay? So they need the ability to be able to connect these stablecoins to bank accounts in different jurisdictions. They need the ability to on-ramp, to off-ramp. They need the ability to swap or bridge between different stablecoins. So, in many cross-border use cases, for example, you can collect money like Latin America, and usually their USDT is very dominant on Tron, but then you need to off-ramp it to a US bank account, and then USDC is much more dominated. So you need the ability to do this swapping, bridging between these networks and assets as well. They need things around compliance, okay? So they need to take care of AML rules, they need to take care of travel rule, so they need solutions for that. And also licenses, in a way, okay? Sometimes the typical payment license is enough. In some areas, for example, in Europe, you still need a MiCA license in order to operate with stablecoins. We at Utila, we are mostly focused on the wallet side, okay? So the focus of the company is how you secure wallets, how you create them in scale, how you initiate and sign transactions in scale, how you manage users and policy around it. But we also built a lot of tools to connect to the different other Lego blocks that I just mentioned. So you can easily connect these wallets to liquidity providers, to AML providers, to travel rule providers, and soon even to licenses.
Right, and so how many licenses, how many wallets, orders of magnitude are we talking about that you manage now?
How many?
How many, just as a reference point, how many wallets would that be?
For basically, I would say that it really depends on the flow. It really depends on where you want to operate. Mm-hmm. In some areas, in the US, for example, you need MTLs for every state. In Europe, you need NYCA.
Right, but there's like, aren't there like 2 billion wallets or something like that?
Today.
Oh, yeah, it's.
I think
What
it
is the
depends,
number?
I think it depends geo by geo. I think in the U.S. it's something like at least 50 to 100 million Americans have interacted with crypto. That I
Right,
suppose
but some
there's-
people have multiple wallets.
Also, the term wallet
Yeah,
is
I
a
thought
bit
it's like 2
misleading
billion or something.
because there are addresses, like some wallets that are created to one-time use. For example, when you do like pay-in, so you will create a wallet, you will get assets, then you will sweep it to a treasury, then you will archive this wallet in a way,
Right.
okay? So I would say there are active wallets, non-active wallets. I think active wallets, I would say around the low billions, I believe.
Multiple billions, yeah.
Yeah, somewhere in that range.
Okay, let's, Malik, what do you, Farooq, I mean, what is your, where do you sit in the stablecoin stack?
Yeah, and for us, right, when we saw this taking place, right, the expansion of the stablecoin infrastructure, we were reading a lot of more technical materials coming out of central banks globally. What we learned from that was that, CBDCs, tokenized deposits, stablecoins were mentally in the same space from a regulatory perspective, and especially at the central bank level. And so our thesis when we built Rain was really about how do you go from here to there, right? So when you looked at central banks, what they wanted to see was the stable coins or digital money as the enabling technology for the future of money movement and financial services. At the time we started building Rain, we realized that it really wasn't, right? Because it was mostly used by folks that were already in the digital asset community. They were using it for operating their own business. And there was a pretty large gap. And the biggest piece of that gap is really the ability to settle and authorize transactions, right? So authorization of a transaction, whether it's a sending transaction or a receipt transaction or request for pay, or a card payment transaction, which can be an ATM transaction, it can be a credit transaction, it can include fuel dispensers, all sorts of different things, tipping. And so we realized that there was a lot of complexity in the different types of transaction requests that exist in the current world. And the blockchain was limited from how it operated vis-a-vis these types of transactions. So Rain, at the heart of it, is an authorization and settlement mechanism. And we've deployed this technology natively on over a dozen different blockchains. We support more stablecoins than anybody. We operate everything as a single user balance. So it doesn't matter what chain you're on, what token you're in, or where the money needs to go. So it can go to Visa, it can go to an off-ramp, it can go to another person's wallet. And so Rain, at the heart of it, is really the utility layer for digital money. Because the primary use of money, right, for all of us or businesses or anybody, even governments, is to spend it. Mm-hmm. And so we just built the tooling to let people spend this at scale.
Okay. Yoshi, where do you sit in this?
Yeah, so I think we're a little bit different from others. We are very old school, FINRA regulated, DTCC member, self-clearing brokerage firm and clearing and custody. But since I guess like 5 years ago, we realized how the world is changing, where things between the TradFi and crypto just becoming one, and then we saw that whole financial system is moving fully on chain. So in that context, even though we are extremely regulated, traditional self-clearing custody firm, we think about how we use a stable coin as what we've already used in the dollar for, which is one, funding and withdrawal from the end retail customers globally, and then two is that instead of holding US dollar to purchase NVIDIA stocks, they can hold stable coins, or I would say tokenized dollar, to be able to do that. So for us, it's for us, using the stable coin is utilizing that similar way as people already use the US dollar. Mm-hmm. That's how I think about it, from the kind of coming from the fiat and seeing the whole systems moving on chain.
But how much of that, right, and today, how much of that is really happening? Is the percentage of your transactions
Yeah. So even though we've been preparing for this for 4 or 5 years, reality, looking back 1 year or 12 months ago, it was 0.004%. Mm-hmm. Now it's 4%.
Well,
it's a big ratio jump, right?
That's 1,000x, right?
Exactly.
Yeah.
So yeah, it's coming.
Okay, Aklil, you are the largest U.S. crypto exchange, and you sit in the middle of a lot of parts of this.
Yes.
So maybe talk about that for a second, and then where do you see, and I'm really focusing more on the real world adoption, where do you see that those both institutional and retail customers moving
Yeah.
for real world use cases?
Yeah, I think it's a really well framed question on where do we sit in the stablecoin stack. I mean, most people know of Coinbase as like the retail facing brokerage and exchange, and that's interesting and cool, but it's not really, I think, where we see the next 5 to 10 years of the business. And I think in order to kind of say where we sit in the stablecoin stack, it's worth taking a beat on where are the various businesses that Coinbase operates to this day. So in my view, you have the traditional kind of payment stacks, so ACH, debit, credit, banking integrations, these sorts of things. And then you have sort of like the crypto native stack, which I would kind of call protocols, so the underlying blockchains like Solana or BTC or Ethereum. You then have infrastructure that sits on top of that, and then you have applications that sit on top of that ultimately serve end customers. And to try to plot Coinbase's business across these two things, I'm going to do my best to do so. So we operate a protocol. So we have Base, which is a layer 2 blockchain. It's a very cheap, fast, efficient layer 2 that enables the movement of money and assets on chain. We also operate a little, less well known, but a growing part of our business, which is at the infrastructure layer. So we have a business called Crypto as a Service, where we enable banks, fintechs, brokerages, exchanges to sit on top of our custody, be able to route trades and leverage our custody and our liquidity for a trading use case. And then we also operate a whole multitude of applications at the application layer, both primarily for both trading and payments use cases. So we sort of operate at both the application, the infrastructure, and at the protocol layer. And I think one point not mentioned in this infrastructure stack is we also have a pretty unique relationship with various various issuers in the ecosystem, including Circle. So we have a direct economic relationship and strategic relationship with Circle, which is among the largest top 3 issuers in the world. And so I think we benefit from that relationship. And taking a step back, Coinbase has a vision to create an open financial system for the world, which is why you're seeing kind of various kind of diversified bets across the entire ecosystem, with ultimately serving this longer term, vision of like creating this open financial system for the world.
Right. So where do you see the most real world adoption taking place? Is it consumers driving something, or is it businesses, and what is it? What do you say?
Yeah, good question. So I think on the trading side of the house, stablecoin adoption has been here for a very long time. We've serviced a retail-facing exchange and have had USDC or USDT denominated pairs and have served that for more than a decade. Now, on the payment side of the house, we do see a decent number of activity, but a lot of the send-receiving activity is just sending to self. I think a common trope that a lot of crypto people know about is, hey, you on-ramp with Coinbase, you send it to Bybit, Binance, and then you go trade Farooq or whatever it is that you want to trade. So that activity definitely exists, but it's smaller as a proportion of what we would in this room probably consider real activity or real utility. Conversely, I think where we're seeing a lot on the enterprise side, which I would estimate is larger in Coinbase's kind of broad business ambitions to be much larger, is enterprise adoption. Yeah. So for us, we're seeing institutions that want to use it. We're seeing businesses that want to be able to send and receive payments. People who are in the business of money that want to make their businesses cheaper, faster, more efficient, and global. And so I'd say the direct answer to your question is we're seeing much more adoption on the payment side from enterprises, but for trading, I would say retail has sort of been around for a really long time.
So I had a rule at Visa, which is in payments, if you want to compete with Visa like on debit settlement, you're nuts, because the system essentially is never down. It really doesn't cost very much, like other than the interchange component. So focus on the things that have been successful is focusing on transactions that don't happen. They don't work. And that, I would say, explains how Stripe got started, essentially, how Square got started, how eBay got started. It's basically saying there were no transactions there. They were too small. Took a year to get a merchant account. So what do we see, and Bentzi, I'm going to focus you on this, is you got a business customer, let's say, or fintech. They want to do something that's not possible today, and then say, well, stablecoin solves that problem. What's an example of that?
Yeah, I will give a few examples. So one is basically, so we serve PSPs, for example, that are working with merchants that are, let's say, based in the US, and they are collecting money in Brazil for them, okay? One of the challenges they have today is that, let's say they are collecting Brazilian real in Monday. They need to keep it in the Brazilian bank and they do 1 week, one settlement a week to a US bank account, and then they move it to the merchants in the US. The problem they have, which actually stablecoins are solving, is volatility risk in the meantime, okay? Imagine on Monday, the rate of the Brazilian real compared to US dollar was X. It can change. Many things can happen over a few days. And then what they are starting to do today, they're actually on-ramping immediately from Brazilian real into like USDC, USDT, like locking actually the day value of the stablecoin. And this is like solving for them volatility risk, okay? Another thing that we see is actually enabling dollar access in areas where dollar access is limited today. So think about LATAM. We see neobanks utilizing stablecoins behind. A good example is DollarUp. And basically, the experience is a bit like the cloud, okay? Even the end user is not really facing stablecoins. They see dollars, but there is like stablecoins behind. The general idea of stablecoins is enabling you to create bank by code, okay? If I want to create like a similar bank, if I wanted to do it 10 years ago, there are like many Lego blocks I need to take care of, okay? In stablecoins, I can create a bank in like minutes, if that makes sense. And solving like dollar access is another big use case that we've been seeing. Also like opening like, new borders, okay? So for example, if today is very difficult to deal with like businesses in Africa, I think stablecoins are a very easy way to provide like the ability to open businesses there as well. And that's why in Utila, to be honest, most of the, and recently I heard a podcast, it was pretty accurate that it's a bit like WhatsApp. Okay, like if you only deal with businesses inside the US, you will probably don't need a lot of you don't need stablecoins a lot, but when you start dealing with people out of the US, you install WhatsApp. And
I think that actually, I think is a good example of the rule. And I think we were talking about this beforehand. I want to maybe switch to this a second. One of the reasons I think that Visa and MasterCard have been so successful is there's a well-known set of rules for reversibility and chargeback of transactions. And so if there's fraudulent behavior or your invoice is not fulfilled or there's it's an illicit transaction, the transaction can be broken. And you may not like all the rules, but the rules are there. In the direct-to-merchant category, there's no rules. Can you create rules? Who's going to create those rules that are predictable, universal? Are we going to have different, this is for risky consenting adults type rules, or this is for normal people who just want to buy a bunch of electronics in Vietnam?
No.
And it's 45 invoices are going to be settled in one marketplace. I want to pay by digital currency. Who's going to write the set of rules to govern that transaction?
Yeah, and so for us, right, it was really important to bake the technology to support the rules that exist today, right? So today, if you use Rain's payment infrastructure on the blockchain, you can still charge back. You can still be refunded funds into your wallet on the blockchain. I remember when we first launched this with customers, some of our customers reached out to support and they're like, I know that this is on the blockchain, and I know that if it's all, I suspect it's all fully gone forever. I messed up. Can we charge this back? And we said, yeah, you can charge this back. And we charged it back and they got their money back. And
but is that a bespoke, is that like in the fine print or there's a set of rules with 5 key principles that everyone relies on?
No, so when we followed the principles that are enshrined by the Visa rules and MasterCard rules, right? So we have the ability to do the same type of transactions that go through the public open loop networks that exist today. In addition to that, we've built our infrastructure so that if you sort of architect a solution using our tech on the sending and receiving side, you also can benefit from the same Visa rules that exist. Obviously, that bilateral agreement is really about how we implement those rules in a bilateral pathway, but the primitive exists so that you're not leaving that behind, right? And the thinking here was that it's so early in this market, we wanted to design the infrastructure to assume that some of the best things that have emerged over the last 5 decades in Visa, MasterCard, Amex, et cetera, all of those things should be able to make the transition to the future, right? There's a lot of good that has been developed through iteration over the last several decades. And when you shift from one technology to another, you shouldn't be leaving everything good behind, right? Just because you're betting on something new doesn't mean you need to eliminate everything and start all over again.
But
right?
if you look at everything I've ever seen, any pitch to the merchant, it says no chargebacks. That is number 2 or number 1, instant, and no chargebacks. And so I imagine there's a customer selection bias.
No, for sure. And I think that we're still not quite there yet where merchants are going to be receiving funds at scale from stablecoin native transactions. Like our customers are transacting at, like our customers, every program we do, we have several hundred programs we power today. Every single one of them, whether it's a stablecoin native program, we also power programs for like an airline, which is using our infrastructure to issue like per diem cards powered by stablecoins to all of their flight attendants, right? Like this is a pretty interesting use case. We have we have one of the world's largest private banks using our card infrastructure to issue payment credentials to customers of their private bank around the world. And they're transitioning from an existing very well-known program to us because we have a larger addressable universe of customers we can power. And the capital markets facility for that is entirely on the blockchain. So we borrow that 7 days a week, 24 hours a day. We can settle those transactions programmatically, even if we end up in a situation where some customers are prime, some customers are subprime. At a private bank, you generally don't have that problem, but we have other clients that are not in that modality and they have like a prime, subprime issue. And we can issue the same credential to them and we can program the swipe to go to a subprime lender and we can program the prime swipe to go to a prime lender, right? All of that happens instantaneously at scale automatically without anybody having to design 2 separate programs, sign 2 separate agreements, negotiate 2 separate warehouse lines. And you can actually automate this whole thing where, let's say this month I'm prime, next month I'm subprime, my transactions will automatically end up at the lender with a demand for my paper. And so all of this stuff is now programmable, whereas previously it was something that required a pretty expensive administrative exercise. And that's where I think that, with merchant acceptance, that will come. Like we're starting to see transactions settle. So we settle 100% of payment volume with Visa and stablecoins. Visa settling payment volume with merchant acquirers in stablecoins 7 days a week. Many of those flows are actually ending back up into RAIN-powered accounts so that on Saturday when you receive the tokens, you can spend them again.
All right. Let's switch because I want to talk about the $500 trillion opportunity, which is the capital markets. How about, repos seems to be a pretty obvious category. Why is that not, where is that? I don't even know who's driving it. I mean, BlackRock has talked about, but I don't know of any specific things. But what would you say is going to happen first? And maybe we also apply the Visa rule I mentioned, which is you have a large functioning system. Yeah. It's hard to change it.
Right.
Where would you go?
I think like what Farooq was saying, like it's very makes sense, right? Like, what has been, there's an iteration by Visa and MasterCard. It's the same thing as, capital markets structure. So we do have, in the United States, there's 1933 of Securities Act. There are a lot of iterations of making sure that, we should not do this, we should do this. What is, investor protection? What is, segregation of the customer funds and all those things? And I think those have to be really, really followed. And obviously, stablecoin right now, even with the Genius Act, the laws are not enrolled yet, so we cannot really apply that.
Did you see, how many people here took a look at the Control of the Currency's 365-page proposed rule this morning? Did you see that? I did. I can tell you, it's actually very impressive.
Yeah.
Very well done. But we can talk about that later. But keep going. But there's a couple of things in there. I think some real zingers that we should talk about.
Yeah. So I think from that, learning about what worked in this fiat world, we have to follow it. And then I think another things that when we look at the news or headlines that come out, we kind of have to also think about this is for more of the institutional setting of how the market is working, as you were saying, as repo market.
Yeah.
There's a lot of transaction happening on the Canton, right?
Mm-hmm.
And I think Broadridge is involved with that too. And then there's more of the retail aspect where people don't care about retails don't care about repo market, but they care about stablecoin because it's FX and dollar. and then stock market because like that you want to have better accessibility. And there's a different efforts that's happening as well. So we kind of have to think about like multiple angles, and there's a multiple different methodology of things happening right now.
Okay.
So
We're going to run out of time. There's two big topics I think we should really talk about, and one is probably in this current market structure law, which is being debated endlessly in the United States, which Coinbase demonstrated their rather remarkable political power by the CEO saying, "We will not support this law," and it died. But yield. Everyone here knows about stablecoin yield. Who doesn't know anything about stablecoin yield and why this is a big issue? So everyone knows. Everyone here is an expert. We could start talking about this like experts. So the big topic is, can you pay a yield or can you give a rebate on stablecoins? And otherwise, there's a big problem. You get a stablecoin, it doesn't have a yield. And as I said, in the treasury, in the corporate treasury market, that's just a non-starter. No one's going to hold an asset that doesn't yield anything. If you live in Argentina, stability might be good enough. For Nigeria, and if you look at the markets where stablecoin traffic is the largest, it's Argentina, Nigeria, Indonesia,
Brazil too.
Brazil.
Like, the Brazilian.
Yeah, probably right now. I bet Iran has pretty high volume. But so, okay, how is that going to work? I thought was actually fascinating in the OCC regs because the Genius Act says no yield, absolutely. But they basically are saying you can have a relationship with a bank that's not the issuer. So it may hurt your issue as a service idea, but basically says you can give them a yield. So it strikes me that what they're saying is once the stablecoin itself doesn't have a yield, but it can then turn into something that does have a yield in certain circumstances, and the OCC seems to approve of that in an explicit way. So that's my quick reading today, but I don't know if anyone else has an opinion.
I mean, it's kind of like my bank deposit, right? Like right now, it has no yield, but then I ask them to sweep it overnight into a money market fund, and then it does have yield. But then the whole premise of this from banks is that, oh no, banks have yield, so that's why stablecoins shouldn't have yield. But in fact, most banks in the United States, the profitability is driven from zero interest bearing, like no interest bearing deposits, right? So there's a lot of incongruity with what various folks are asking about. And a lot of it is sort of asking for things that matter meaningfully to folks that are asking for them. And I think that, as a neutral party here, I think that there's credible arguments on both sides. But I don't think that any of this stuff is necessarily new. And even if you look at a lot of the commentary and a lot of the feedback from the ABA, et cetera, or the Bank Policy Institute, and you look at the same stuff that was said by them about money market funds, it's literally copy, paste, change the year, ship it. And it's not, and if you look at what's happened with the money market funds are run by banks. And I think that there's a universe in which some stable coins will be issued by banks. Certainly, like I said earlier, we're already working with tokenized bank deposits. We're launching the first tokenized deposit linked debit card with a partner bank, right? So there's a lot of interesting innovation that can happen. I think the disappointing part about this, Hans, is that if you look at what everybody's trying to focus on, people are trying to protect what is known rather than optimizing what is possible, right? And I think that whenever we think about these types of things from a negative perspective where, oh, I'm going to lose the piece of my pie that I have today versus the pie is going to expand and the opportunity to monetize that is going to expand, that is actually very sad and depressing.
I would say, actually, from my experience, that's changing pretty quickly right now.
Yeah.
And I'd say, we had a roundtable with about 15 corporate treasurers, large global corporate treasurers in May of last year, plus global treasury banks. And it was like all these problems and everything. It was like, you were at that, Bentzi. Remember when we did that last May, when we had that roundtable? And problem. Now there's a lot, it's changing. But the use cases are like, hey, there's things having a global account. That's a big deal. Actually, one thing I just, big company, Fortune 80 company, said, yeah, well, Visa, MasterCard don't allow you to do these types of things, which are not like, child pornography, but things like, well, you can't do cannabis. There's lots of things that you can't do, which actually you can actually enable in stablecoins, and they're not necessarily problems, but they just solve hangups that exist. I'd like to, let's go back, because I want to make sure we have time for this and a couple of other things, but well, actually, we talked about this a little bit. I've always been hung up on the stablecoin sandwich problem. Like if you want to exit into fiat to pay bills, it's expensive, and it can be really expensive, and you don't have liquidity in these markets for institutional business. How is that going to change? Is it changing right now? Is liquidity dramatically better? And what might happen? Shouldn't you organize capital pools around this? That would make it a lot more efficient. But who's got Aklil?
Sure. Yeah, I'll give it a whirl.
Since you can censor a bill and with this, wave of your hand, we'll let you comment about this.
Yeah, so when I first became obviously aware of like what was happening in stablecoins, specifically in relation to payments, I sort of had the same inclination. Stablecoin sandwich, you got an on-ramp on the way in, then you got to send it, and then maybe you got to do the off-ramp, and doesn't that going to be more expensive? And I think it comes down to what the gentleman on the right here said with respect to what it means to exist in the traditional financial system relative to what is possible in the crypto system. And I think in short, what I would say is that there are issues on certain types of flows, on certain currencies to off-ramp into certain other fiat currencies that are just like T+10, and you're taking all kinds of volatility risk. And I had approached the opportunity with the same level of healthy skepticism, at least initially, but then upon talking to customers and in kind of regular course diligence, people would say things like stablecoin, schmablecoin. As long as you get me not T+10, I'll buy whatever the hell you're selling. And I think from my perspective, there are going to be flows and currencies that are going to be overall cheaper and a much better experience in terms of settlement time, speed, and cost. And so I think that's where you're sort of starting to see the product market fit.
Yeah,
Okay.
I think from the capital market side as well, because the investable assets is becoming tokenized, which there is no more sandwich problem, right? You need to unwrap it to send it, and you can just use that to purchase that fiat risk. And I think that's getting resolved, and that's why I think it's important. The removing the sandwich problem is how to get this whole stablecoin infrastructure as useful as possible.
Okay, let's go. So we said that there's the 1.2 quadrillion opportunity, and I broke it into 5 categories. So we say payouts, 25 trillion, B to government and back and forth, 25 trillion, buyers, suppliers, 150, treasury, intercompany, 500, capital markets, 500. So in 3 years, when we're sitting at this conference, what do you think the penetration rate is going to be in each of those? Who wants to go first? Yoshi, you go first. You're a capital markets guy. You have the most knowledge about the 500 trillion. So right now you're 0.4%.
To 4% now.
You're 4%.
4% now. Yeah.
Oh, that's pretty good.
Yeah, so it's pretty good, right? So I would say,
3 years.
33.
33%.
Yeah.
All right, that's a big bold. And what do you think about treasury intercompany?
I think I would think about a pretty similar number because it's pretty correlated in terms of tokenized assets trading volume and custody amount, and then actual stablecoin use. It's pretty similar numbers. So
Okay.
with that,
How about buyer suppliers?
that I don't have much of the clue. It may be I don't know. It's maybe actually lower because of the sandwich problem. It's kind of hard to get rid of if it's using the actual assets.
And government payments back and forth?
I think it's actually go a little bit faster because I think institutional money movements right now, it's getting more involved by DTCs and NYCA and everyone. So,
Okay, payouts.
The payouts is I think it's lower.
Lower.
Yeah.
That's very interesting. Okay, who wants to go next?
You mentioned the remittances number, right? What was it, 120 billion?
Yeah.
So to give an example, right? Just in the last 12 months, just Rain has done over 1% of that, right? And I think, and our the CAGR on that on our side is 400% annualized. It's pretty crazy, right? And if you think about the broader market expansion which is taking place, there's a number of companies like Western Union, MoneyGram that have leaned very heavily into stable coins as a way to upgrade and create more resiliency in their existing business. I suspect that number goes to 40, 50% in the next 5 years.
The one thing I think is interesting is competition will drive, the alternatives will come down too, which I think, and they'll use, so But anyway, that's a
Yeah.
good, so you're gonna say 50%. Do you have any opinions on the other big categories?
I mean, I think the payout stuff, we're already seeing significant inflows into payouts and stablecoins. I mean, ultimately, our thesis as a company and just my thesis as an individual is that I think this differentiation between digital money vis-a-vis regular money is going to go away, right? If you think about what a lot of the regulations are about, they're about creating the framework to treat this technology as legal tender, which means that it's the same, right? Like eventually with like mobile phone calls to regular phone calls, no one here calls a phone call a mobile phone call anymore. It's just the vernacular has shifted because that's how you make phone calls. And so the same way here, right? Like money is one type of money. It's two types of money now, right? It's cash, which is a piece of paper, and then there's electronic money. Digital money is a non-fungible way to get cash dynamics with electronic money. And it's meaningfully better and more efficient than the traditional way of doing it, where money needs multiple dollars to move, right? Like you have all this float locked up in all of these counterparties globally. All of that costs money. All of that is an opportunity to go away or eliminate the redundancies.
But I need to interrupt you because we got to finish this. Do you have a prediction?
It's tough to say. I mean, to be honest, I mean, some of this stuff is just so freaking early. I mean, obviously the numbers are pretty remarkable, but I think the only way you could really get to a deterministic like point of view is go and meet all the companies that are out there in the space on the front lines, kind of experimenting. I mean, we have through Coinbase we have over 560 portfolio companies we've acquired north of 40 businesses, and so I've had a unique vantage point into looking into many of these businesses. And what I can tell you is that it's a lot of stories that Farooq just told here, where they're taking numbers that we would kind of find on a page or find online and saying like, oh my gosh, if you add all these things up, it's actually much larger and growing much faster than we could possibly fathom. And so I think that's just a hallmark of what you see in any one of these early new technologies. It's tough to kind of call it. And I don't know, there's that famous story about how there was a sell-side analyst who tried to estimate the size of Uber's total addressable market by looking at the asset taxi industry. And I think famously got it like orders of magnitude wrong because he tried to DCF the thing. And so I think from my POV, it's like these things are going to grow asymmetrically, and at 400% CAGR. If you add up all the companies that are in this category that are experimenting on the front lines, I think you'd find that it may be growing much faster than we might think.
All right, we're gonna have to end it there. You get to think about it, and then you can make a better prediction tomorrow or something. So let's say, but I thank you all. This is an excellent panel, and just remember, 1 point true quadrillion. Thank you.